Hi, and welcome to Macro Monday, where we talk macro, try to make sense of markets that don't make any sense, and more importantly, answer your questions so we can become better investors. I'm Steven Van Metre. I'm your host today, and I got a great show for you today. And I'm sorry, I can't help but be chuckling a little bit today, because on any day you see a market surge, I get a whole bunch of emails, phone calls, texts, and I'm not going to name names. I'm not going to even mention the text from my wife about why the market went up. And it's all of a sudden, it's people like, how can the market be going up? Did something change? Do we need to do something? What's going on? Are you going to talk about it today? What happened? How can this be? And the reason I'm chuckling is not directed at any one person. It's investor psychology. And it kind of makes me chuckle a little bit, because when you work and live in the world of macro, when you build your investment thesis around a macro view, sometimes a micro event such as today, stocks went way up, can have people suddenly question everything. Well, is it because now that we've reached a certain level of debt? Did something change because of what the Fed's doing? What's going on? But that's not how macro works. In order for macro to have a sudden reversal, you'd have to have something very specific. So, for example, did the laws governing our monetary system change over the weekend? No. Did our monetary system change? No. So something changed. Well, Fed Chair Powell did speak on 60 Minutes on Sunday. We're actually going to talk about that. But no, nothing changed. But sometimes psychology and impatience gets into play. For example, I'm watching this pretty mediocre TV show right now, and it's a cop show, really, it's a cop-ish show. And one of the cops is told that he needs to meditate. So he goes home that night, and the next morning he's in his car with his partner, and he says, meditation doesn't work. And his partner goes, what do you mean, man? Meditation's great. It has all these wonderful benefits. He goes, no, I tried it last night. It doesn't work. Because meditation and macro are the same thing. It's not something that, hey, you just go do it one day and you get the answer you're looking for. It doesn't work that way. So did world all liquidity get fixed last night? No. That didn't change. I mean, we can go and look at the chart from Friday and see, well, did somehow the cash held at Federal Reserve banks mysteriously now get injected to the economy? No. Did the law change where the Fed can directly fund money into the federal government? No. Well, that didn't change. So that's still deflationary. Oh, I know. It's got to be because the Fed is cutting back their quantitative easing. And finally, they reached the whole point where they just cut or tapered enough that, bam, that made a change. Well, does that make any sense? Because I thought the whole view for stock investors was the quantitative easing was bullish. So if the Fed is tapering, how is it bullish? Does that make sense to you? It doesn't make sense to me. Arguably, it should be bearish. There it goes. So no, that doesn't make any sense. And no, the amount of quantitative easing the Fed does is immaterial. We're going to conclude on Friday our three-part series on quantitative easing really doesn't do anything, I think is what the title of Friday's video is going to be called. And if you're new to the show and you're curious about why my view of quantitative easing is deflationary, you want to go back and watch last Friday's and the prior Friday's video, and maybe some of the ones in between. And it'll really give you an idea of why quantitative easing really doesn't do very much. I mean, it has two specific things that it accomplishes. One is deflationary, and number two, it lowers short-term interest rates. It doesn't do anything else, but everyone thinks it does something else. So what changed that caused all of a sudden investors to come screaming into the market today and drive stock prices up 3% on the S&P? Clearly something must be different now. Clearly the market must know something that we don't know and no one else knows. Inflation must be back. There must be a surge of new activity in the economy. No, nothing changed. Nothing changed except investors heard what they wanted to hear. Now, Sunday night, And I believe this is the second time. I know for sure. I don't know if it could be the third time. This is definitely the second time that Fed Chair Powell's been on 60 Minutes. This is highly unusual for Fed chairs to be on, TV this often. But he went on 60 Minutes. Now, I actually didn't watch it. Steve, how could you not watch the Fed chair speak? Look, I knew he wasn't going to say anything I didn't know. I could look at the futures market and tell you what he said. I didn't need to watch it. I had to watch this terrible show that I'm watching instead because I think I'm almost to the end of it. Well, you at least read what he had to say. Well, actually, I skimmed it. How, Steve, how could you not read it? Because I already know what it says. In fact, I skimmed it until I found the lie. The lie? Yes, I found the lie. I'm going to show it to you. He lied. But he gave investors what they want. I remember when I was in grade school and somebody was running for class president. I imagine obviously that happened every year. And somebody got up and said, vote for me. I'm going to put soda in the soda fountains. Yay! Now, maybe there's a point where you go, hey, wait a minute. That's a good idea. Why don't we have soda in the soda fountains now? Because it's not ever going to happen. You see, Fed Chair Powell said last week what he's going to do. So I already knew that when he went on 60 Minutes, it's just some puff piece to help the masses who don't actually listen or know what he's talking about. He said there's two things that he's going to do. Because remember last week on Thursday, which was a week of I think the heaviest Treasury issuance in history, could be wrong, but it was a huge week of Treasury debt. On Thursday, he spoke in front of, or by video, to an economics club who I think everyone was at home. And everyone wanted him to talk about negative interest rates. And he didn't. He said, that's not on the table. This weekend, I did some more reading about that. And it turns out that negative interest rates are likely illegal. And the Fed can't do it because the Federal Reserve Act doesn't allow for it. As I said, I don't think he's a guy that's going to go down that path. So he said in that Thursday speech, there's two things he's going to do. One, he is going to do quantitative easing. That is a policy tool. Number two, he said forward guidance. Well, what's forward guidance? It's like Babe Ruth. That's forward guidance. I'm going to hit the ball over there. Also known as jawboning. Now, why is that important? In fact, it's probably the most important tool in the Fed's toolbox. So why would he suddenly come out on Sunday, go on 60 Minutes, and jawbone? Because he knows quantitative easing isn't doing anything. And we can look and see it's not doing anything. Look at the market. It hasn't really done it. Yeah, sure, it came off this here, but it's not making a new all-time high. It's really doing nothing. And recently, look at the Treasury market. Other than this move really today, it's effectively done nothing. It's not creating inflation. It's not doing anything. So he had to come out and tell people, because Fed, the government, all the underlying agencies, they don't have the power we assign them. I've said this story before that when President Reagan was facing a double dip recession, the Bureau of Labor Statistics started faking the number of jobs being created. Because what they figured out is that if Americans believed more jobs were being created than were actually being created, they would go out and look for work, and then some of them would spend money. It would become a self-fulfilling prophecy. And guess what? It worked. And ever since then, the BLS continues to fake the number of jobs. We continue to be like, oh my God, the BLS said this many jobs are created. Oh, there must be truth. And then like a year or so later, I'm like, oh yeah, we were wrong by like 1 million jobs last year. And everyone's like, oh, well, whatever. Because it's a self-fulfilling prophecy. And the same is true with monetary policy. Everybody believes that quantitative easing can make stock prices go up. But as long as it makes people believe it does, so they'll go and buy stocks, stock prices will go up. So when they don't go up, what does Powell have to do? Jibber jabber. He's got to get out there and tell people, look, I'm going to do some more stuff that you don't understand. It does nothing. But hey, as long as you think it does something, it's going to work. And you got to think, Powell's term is up not much longer after President Trump faces re-election. And Powell doesn't know if Trump's going to be his boss or if he's going to have somebody new. He doesn't know. So he's got to go out there and make it look like he's doing his job, because he has said in the past, I want to be Fed chair next term. I'm not stepping down. So let's look at what he said, because I have the interview here, thanks to CBS News. And I literally just skimmed through it until I found the part that I wanted to find. And I didn't know it was going to be in here, but I had a hunch. And so they were talking about where the money comes from. It's fair to say you simply flood the system with money. Powell, yes, we did. That's another way to think about it. Yes, we did. That is not true, but nevertheless, where does it come from? Did you just print? Well, we print it digitally. So as a central bank, we have the ability to create money digitally. That is correct. They can create it. They can't print it, but they can create all the money they want. And we do that by buying treasury bills or bonds or other government guaranteed securities. That is correct. So when you look at what he's saying right here, all we do is swap cash for bonds. That's it. It's a swap. That's all we're doing. Now, so far, that part is correct. He's literally just giving banks cash that has to be locked up in an account at the Federal Reserve Bank that they cannot withdraw from. In exchange, they give him back a bill, treasury bill, note, or bond. Let's continue. And that actually increases the money supply. Lie. We also print actual currency. Lie. And we distribute that through the Federal Reserve Banks. That's the correct part. So this statement is correct when you pair the last part of it together. The lie is right here, and we actually increase the money supply. This is false. The Fed does not have control over the money supply. The Fed has two policy tools. They can raise and lower the federal funds rate, and they can engage in open market operations, as we refer to as quantitative easing, where they can buy or sell treasury securities. Neither of those show up in the M2, M1, or any other money stock measure. Federal funds rate doesn't show up on anything. Quantitative easing, it's the monetary base. So the correct language he should have said is, we can, increase the monetary base. He did not say that. He very carefully chose his words. If you don't think that most of this interview was likely scripted, where he knew the questions or gave the questions in advance, you're mistaken. He knew exactly what he was going to say, and he knew exactly when he was going to say it. And when he said, quote unquote, then that actually increases the money supply. What do you think an investor is going to think that means? We are printing money to create inflation. What is the expected response to that? People are going to run and buy stocks, and they're going to sell bonds, and they're going to buy commodities, because those are things that people believe keep up or outpace inflation. So did Fed Chair Powell accomplish his goal? Yes, he did. And that is the point at which I've not actually looked at anything else he said. There's no need to, because he lied. He does not have the tools, power, or legal authority, mechanisms, you name it. The Fed cannot increase the money supply. Cannot. I've shown you in the charts, they cannot do it. But he said they did. And so what do you get in response to that? You get, oh, look, let's drive stock prices up because the Fed has figured out how to make inflation. No, what the Fed figured out how to do was give people exactly what they wanted to hear. He told them, we're going to put soda in the soda fountains. And people said, I finally believe you again. And so they ran out and bought stocks. And then they can say, well, look, quantitative easing causes stock prices to go up. But wait a minute, I thought we reduced the pace of quantitative easing today. Well, we did. Do you see how this doesn't make any sense? But do you also see why forward policy is the most important tool the Fed has? Because as long as people believe, there is a chance, a hope that this will get us out of the problem. Now, will it? No. Because as long as the Fed is engaging in any level of quantitative easing, it is deflationary. But yet, there's nothing more he can do. People say, but quantitative easing isn't keeping up with the amount of debt issuance. It doesn't matter. It doesn't make any difference. We're talking a cash swap for treasuries. That cash that the banks are giving up, where does it go? It goes into an account of the Federal Reserve Bank that they cannot withdraw. The banks cannot take the money out, or else it would be money printing. It doesn't do anything. So nothing changed, except it got investors excited to push stock prices higher. It got investors excited to sell bonds. And the interesting action wasn't in the equity market. It was in the bond market. Why is that? Well, let's take a look. There was, if we zoom in, an open gap here between the closing and opening value on 30-year treasury yields. I don't like gaps because it means they need to get filled. Well, we filled it today. Now this closed down a little bit from the peak. So it filled that gap, but it created a new gap. It created a gap right here. But here's what people don't notice is there's a gap right here. See that? Right there. There's a gap between the closing value and the opening value the next day. See, the market gives you little telltale signs if you want to go look for them. Because markets generally clean up these gaps. I mean, you're talking like high 90% of these gaps eventually are all closed. And the more orderly a market is about closing them and clean them up, the better it is. And in this case, in the bond market, since I am very strong in my opinion of deflation, what we have here is a telltale clue that the market today went and cleaned up the gap right in here. There are no other gaps that it needs to clean up. It's cleaned up all of them on the upside. Now, it doesn't mean yields can't go higher tomorrow. It just means it cleaned them up. It left us a gap here today, and there's been this gap right near the all-time lows, just sitting there waiting to be filled. And if you don't believe it will be filled, these gaps in the past at these low levels have been filled. Now, we can also look at TLT. And I like to look at TLT because it's a little more granular, but it had a gap that we couldn't see on the treasury yield. So let's zoom in here, and there was a gap. Let's try to zoom in a little finer. There was a gap right here going back to the 11th, so last week, and you see the closing value and the opening value gap right here. And what happened? We saw prices go all the way down and fill that gap. And what happened today is as soon as that gap was filled, buyers came in, brought prices up. You notice volume ticked up, volume started picking up, and then it dipped again, and then boom, right into close, we see a little bit of a nice move. Now, why would the market let prices on bonds come down? Well, who's the biggest seller of bonds to the Fed? Oh, the only seller, the large commercial banks. So if you had the biggest amount of treasury issuance last week, so let's zoom back out and look at the 10-day view, meaning you were buying bonds as a bank all right in here. Now, you know you've got to sell these things to the Fed because the Fed, you don't have a choice. I think I got a question that we'll get to at some point, is why don't the banks just not do it? They don't have a choice. Look, Fed is the biggest bank in the planet. I think the BIS might be a little bit better than they are. But in our world in America, the Fed is what matters. When the Fed says we are going to buy bonds, commercial banks, the commercial banks say, okay, they don't have a choice. So why would a commercial bank want to drive bond prices lower after they just bought all of these bonds up here? Oh, because they wanted to get some at a lower price point to mark up and sell to the Fed. So they let sellers come in and drive prices down, and they step in and they're buying probably down here. And we know from technical analysis, which is looking at the price charts and trying to figure out where things are going, we can see that buyers, where this purple line is 1.4%. We've seen buyers all the way right around 1.4 and a little bit higher come in and buy. And we've seen sellers up here between the 1.3 and a little under 1.2% up here, sellers. Now, at some point, either the buyers are going to run out of ammunition, which would be hard because the Fed is buying, or sellers are going to run out of ammunition. And the reality is, given who's on which side of the fence, so I'm going to take the Fed side on this deal. This is like one of those schoolyard sports games. You maybe you're the last one picked, and you go like, oh, in fact, you could pick what team you want because no one thinks you're a worthwhile player. I've been in that position plenty of times. So what side of the team do I want? I want to take the side of the Fed because the Fed has an unlimited ability to buy Treasury securities. The market does not have an unlimited ability to sell them. I'll take the Fed. So there you go. I think part of what we saw today was the market deliberately letting bond prices come down so they could buy down here, validate what was going on, give people all that fear of inflation. Oh my God, the Fed is printing. And what did you see? You saw the bond market validate it. You saw the stock market validate it. And all that does is support my thesis. One of my good friends called me today and he has some questions about this. And he said, if anything, this makes your thesis stronger. It does. Do I worry about 1 or 2 days of price movements, even if it moves against me? No. It's macro. It's macro. I get what's going to happen. I know what's going to happen. In fact, I'm going to show you some more compelling evidence because it is, after all, Hedge Fund Monday. Let's look at the futures market. So thanks to Hedgeopia for posting this every week. I know he doesn't even know that I go over this, but I appreciate it. You can see that hedge funds increased their short position on 10-year treasuries slightly, but look at what they did on 30 years. They brought it down almost to the deepest point where they've been here, which is the second deepest short position in history, and maybe now even deeper than that going into this week. Who knows? So the notion that interest rates are going to spiral out of control when hedge funds and other speculators at their shortest or near shortest position in history, it's not how it works. Interest rates peak when hedge funds go long. You see they go up and then, interest rates are at a peak when hedge funds are short. So there you go. So what this implies is we're more likely at a peak because they've been massive sellers. So if interest rates are at a peak, what does that mean the most likely direction for interest rates is from a macro view? Down. But it gets people excited to question their view. That's the problem in the world of macro. Why didn't I watch the 60 Minutes interview? I didn't need to. Why didn't I read it, but I skimmed it looking to find the lie? Because I knew the lie was probably in there. That's why people send me, hey, would you read this article or you watch this video? Most of the time I don't, but when I do see stuff and I see them pop that chart of the M2 money supply and talk inflation, it's like turn the channel off. I'm done. I won't look at it anymore. And I generally won't go back and read what that person has to say beyond that. Because most people don't understand how the bond market works. They don't understand how the monetary system works. They don't understand how the Fed works. They don't understand the Fed's policy tools. And they come to these bizarre opinions based on no facts. But when you look at the facts and all the circumstantial data, you know what's going to happen. So what is 1 or 2 days? Well, it's not fun. It just is what it is. How about crude oil? China bought like 200 million barrels worth of oil in April, validating some of these people that are long. Do I think crude oil is going back to 55, 60 barrel? No. Probably hang out between 20 and 30, but there's still a lot of long positions. We'll see how that plays out. Hedge funds still net short. Maybe today's rally had something to do with the short squeeze of pulling people out. Wouldn't surprise me. How about gold? We're seeing no real change in gold. Gold's starting to run into resistance here. Again, my view of gold is this headed lower, not higher. Deflation is coming. I mean, the Fed is going to win. There's no question. As long as they're doing quantitative easing, we're going to have deflation. The market thinks otherwise. How about the NASDAQ? Hedge funds backed off their longs a little bit. Russell 2000. Let's see. Hard to say. Net short 18 down. So they increased their net short slightly here. Not really a big deal. They're still bearish on small caps, which would make sense. How about the US dollar? Not any real change here, although I do think the dollar has a lot higher. There's nothing the Fed's doing to fix the liquidity problem other than people believe they are. How about volatility? They increased their shorts on volatility. Not a good play when the market goes up. but they certainly did that today. Let's take a look at a chart, and then I want to get in some questions that you have. Emerging markets. See, if you want to know what would change my view, here's the chart that'll change it. Emerging market stocks are a great proxy of liquidity, and this is Steve's line of doom. And in order for liquidity, in my opinion, to come back to the markets, and for me to have a major change in opinion, I'd need to see emerging market stocks get through the line of no crossing here, thou shalt not cross, and move on through. That would probably tell me liquidity is back. So market is trying to push liquidity through, trying anything it can, but every time it gets up into this line of doom, it reverses. Why? Because the Fed's not actually getting liquidity into the economy. They're just tying money up in bank reserves, not doing a thing. All right, let's go through some questions, and I want to talk about the Memorial Day question special and how to make sure your question gets in on that. First question, this is a long one. The Bank of England recently crossed the line of actually printing money. This is correct. That bypassed the gilt market and went directly to the government in the neighborhood $200 billion, I believe. I don't know the number, but I'll go with that. One of their arguments for doing this is they were concerned about the government having access to funds during crazy volatility a few months ago in the gilt market specifically, but in all markets really. It's been set up as a loan. This is true, where it's supposed to be paid back by the end of this year. However, an important line has been crossed. Correct. In addition, I've read articles where the Bank of England is talking about doing money printing. So this is important. So what this question is talking about is the Bank of England actually did money print. I mean, they bypassed the laws and did it and said, well, we're going to make it a loan and it's going to get paid back. But for the moment, for the onset, yes, this is money printing. So they're talking about buying stocks as an example, but they would stop immediately at the point where their inflation target had been reached, perhaps 2%, really, who knows. Then continue again later if deflation were to rear its ugly head in the future. They are well aware of the dangers of excessive money printing in history. Yeah, they should be. They should be. That's what they claim. Now, my question to you is, can this actually work if central banks decide to do this? The answer is no, it can't work, because rising stock prices do not create inflation. If you think that buying stocks actually causes inflation, call Japan, specifically call the Bank of Japan, who owns a massive amount of their ETF market, and they can't get inflation. That's not how it works. Inflation is not rising stock prices. When inflation occurs is when there is more demand, there is more than supply. That is how you get, if you really want to get not money printing inflation, but if you really want to create inflation, more buyers than sellers, more buyers than demand, more buyers than are on the lot. So this would be like my boy who sells cars. He would love for it if like 10,000 people came down today and wanted to buy a car, because he didn't have 10,000 cars to sell them, and he could sell them at a fat profit and charge people a bunch of money and make a huge commission and have the best day of his life. That is how you get real inflation, when there's more demand than there is supply. Now, you can obviously print your way there, which is a dumb idea, but raising stock prices doesn't lead to inflation. And think about it from the U.S. market. So I'm far more familiar with the U.S. market than the European market. Is 90% of all stocks are owned by 10% of the people. So if I cause stock prices to magically go up somehow because I'm a central bank and I buy them, I'm really relying on 10% of the people to go out and consume enough to cause demand for everyone else. Wouldn't I be better off just putting money in the hands of the 90% of the people who don't own stocks and tell them to go buy a new TV? It probably would. So no, I don't think that works at all. What if central banks create money out of thin air, use those funds to buy equities, but only to the point where inflation stays below their target? I still don't think it works. It would seem to help them in all their goals. Propping up the stock markets, yeah, that is one of their goals, and trying to avoid deflation, but I don't see any evidence that rising stock prices creates inflation. In fact, look at the U.S. Stock prices are relatively close to their all-time high. Inflation is relatively close to low points. No correlation there or relationship to me. There would be a currency impact. This is kind of all one long question. There would be currency impact, but the Fed would be delighted to weaken the dollar. Look, if the Bank of England prints money, they're going to devalue their currency. What's that going to cause the dollar to do? Go up, not down. So wouldn't help the Fed. Actually, would make the Fed situation worse. especially if you're right and the dollar will strengthen. I do believe it will. And that it starts to become a wrecking ball, emerging market debt. Absolutely. There's no doubt in my mind that a rising dollar is going to cause more havoc in the market. And it's only a matter of time before people figure that out. And if you think crude oil at $30 a barrel fixes this dollar problem, no. If you think China buying 200 million barrels of oil in April when it was dirt cheap is a sign that the global economy is turning around, it's not. They just love to buy stuff cheap. And they're probably going to store a bunch of it for all we know. It does not fix the problem. And the problem will get fixed is when U.S. consumers borrow money and spend it abroad. No major sign of that happening at all. So here's how it's going to work. On Monday, a week from today, I'm going to do a special Q&A episode because it is a holiday here in America, and I normally don't have anything to talk about on holidays, so I normally don't do a video. So I'm going to finish all of your questions, whatever I've got left, however many it is, I'm just going to push record and go. But I'm going to record that episode on this coming Friday after I do my normal Friday episode. So if you have a question, you can email to me, you can message me on Facebook or LinkedIn. But there are some rules that I think are important to understand. One, I cannot give trading advice. I do hold a securities license, so I cannot give trading advice. Now, if my view of what I want to look at on the screen happens to coincide with yours, cool. But if you email me and say, well, what about this stock or this symbol or this and that? I can't answer it. I just can't answer it. So that is ruled. We can't do that. No trading advice. Number two, and I forgot what number two is. It's very important. But for some reason I can't remember it. So I will amend number two to be, if you send me a message, please put your name on it. I mean, you could, at the end, you don't know how many emails I get, blah, 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 love your show, you're great, cool, thank you. Here's my question, thank you. Thank you who? I don't know who you are. And I look up an email that says like Big Dog, West Side, woof, woof, woof. I'm like, really? I mean, come on, put your name down there, even if you lie about it. I'm not going to go chase you down. I'm just going to reply and say, hey, Big Dog, East Side, woof, woof, woof. Thanks for the question. Glad you love my show. It sounds kind of dumb. So at least put your name out there so I can at least respond properly. So no trading advice. That's numero uno. And I can't there is a cutoff. If you could get it to me, say Thursday, so I can have it ready for the show on Friday, so in case I need to have some charts ready, that would be cool. So there's some other important thing that obviously isn't important enough for me to remember, but I will remind you on Wednesday how to get your submissions in. And as of course, I appreciate you supporting me and my show. And many of you said you're sharing this with your friends and family and people online, and it means the world to me. I'm glad you're here learning something. And again, I can't wait till Friday when we get to that final piece on quantitative easing, where you really see it just doesn't do anything. And that's pretty cool. I made some cool new PowerPoints because some of you said, hey, your graphics kind of are terrible. Yeah, I know. So I made some PowerPoints. I think they're kind of funny, and we'll see you then. So I'm Steve Van Metre. I appreciate you taking the time to watch, and we'll see you on Wednesday with whatever the market brings us, where we'll get to more of your questions and whatever fun stuff happens in the markets between now and then. Bye now. The content of this video is prepared as information, is provided as educational information only, is not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. In my own personal capacity, opinions expressed in the video that I'm going to do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial.